let's say you have a company that's earning $3 per share now, and you think in the future it's going to grow at, like, let's just say 7% per year, and over 10 years, so that's about a double, so it's going to earn $6 per share in 10 years time. uh, you know, the question now becomes, okay, it's going to earn $6 per share in 10 years time. Let's say at the beginning you're paying a multiple of 10 for the company, so you're paying $30 a share, and it's going to grow at 7%. So in 10 years time it'll be earning $6 per share. And then we figure out some way to apply a multiple to this. So we say, okay, like maybe it's going to eventually sell at, I don't know, let's just maintain it at $10 per share. So it should be selling at something like $60 per share in the future. So we paid 30 for it. It's going to 60. So our return is 7%, which coincides basically with our growth because we're not accounting for any sort of multiple expansion. The multiple in both these cases was 10. But sometimes people will say, well, maybe the multiple on it shouldn't be 10. Maybe instead we should be looking at a multiple of, I don't know, twice the growth rate, so 14. So now we'd be looking at, in this case, 6 times 14, which would be $84 a share. So now we bought it at 30, and in 10 years time we're saying it's probably going to be around $84 per share. And the reason why we know this is because we projected our growth rate being about 7%, and we predict on some level of multiple expansion. Okay, well, what's the problem with this? The problem with this is very clear. It's this final multiple. We ultimately have no clue what the final multiple is going to be in 10 years time. Like, we actually have no idea. It could be 10, it could be down to 3 at that point. We have no way of predicting the future multiple. We can estimate it based off of the growth rate. Like in this case, I'm saying it's 2 times the growth rate. But the issue is that's using backwards looking information. Maybe in 10 years we're not predicting the company to grow at 7% anymore. So if that's the case, we can no longer say, well, it's likely to be selling at 2 times the growth rate because of its historical growth. I don't believe that anymore. I don't believe that there's a way to accurately predict this growth rate. Not the growth rate. The growth rate is in of itself hard to predict, but what's even harder, in my opinion, is that sort of final multiple. We really don't have any idea. Now, it's true that if we have a long enough time horizon, it really doesn't matter because multiples will vary by as much as 100% over the course of a year. The truth of the matter is that this final multiple will probably be anywhere between 10 and 20 over an entire year. So we can pick when we want to sell for the most part. And over a 2-year period, it's probably going to range from like 10 to 25. So our selling opportunity will definitely be there if our horizon is long enough for a decent company. So what is the alternative basically? Well, rather than doing it like this, I think a simpler way to do it is just simply look at what your current earnings yield is. So in this case, our earnings yield, like if it's making $3 a share and it's selling for 30, our earnings yield is 10%, right? And add the growth rate to it. So in this case, where our long-term anticipated rate of return is about 17%. And this is just an approximate number. The reason why this is better is because the cheaper a stock is in terms of its current earnings, the higher our anticipated rate of return is. Same thing for growth. The higher the growth rate, the higher our anticipated rate of return is going to be, without having to do any nonsensical projections of what that future multiple is going to be. Like, why should we waste our time projecting what the end multiple is when we have no way of predicting it? And it doesn't even matter because the range of possible multiples is wide enough that it won't really play that big of a role, right? So, because this final multiple, you can say, oh, it could be 2 times the growth rate, or oh, it could be like the 5-year median. But at the end of the day, it's a bunch of nonsense because it doesn't matter because the multiple varies so much over the course of a year anyways. Like literally almost 100% in each direction, or 50% in each direction. Like if you look at the average company, its earnings, its multiples typically will swing more than its earnings. So what does it really matter? Like its average earnings is what I'm saying. Obviously, its quarterly earnings change all the time, but if you look at its average earnings power, its multiple should swing in different directions nonsensically often. So it'll provide you with a selling opportunity anyways. My point, basically, is that I no longer see it as necessary to take, like, let's say the earnings per share of a company, let's just say $4, say it's going to grow 7% per year or whatever, so it's going to double in 10 years, so it's going to be around 8, and then figure out, okay, what's a multiple to apply to this? Like, let's just say, I don't know, 15 we think is a good end multiple on those earnings, and so we do 8 times 15, and we say our final price is 120, and let's say we want it to be, we want to go like a 5-bagger or more, so our initial buy-in price should be $24 a share or less. I just don't see the point in doing that anymore, because the end multiple is simply not important. I think just a more common sense way of doing it is saying, okay, on this $4 that it's earning per share and it's when we're buying it, what's our initial earnings yield? If it's like 10%, like we said, or 12%, then obviously, because we're buying it for cheaper relative to its current earnings power, our long-term expected return is going to be greater than if we're paying a higher multiple for it. So the point of the video is pretty straightforward. Rather than projecting earnings, I think it just makes a lot more sense, and it's a lot easier and simpler to do mentally, just to say, what's my current earnings yield? And what is my expected rate of growth? It's likely going to be, you're going to likely get similar results without kidding yourself into trying to guess what that future multiple is going to be, which in my opinion is just simply, I've given up on that idea. I just don't think it's worth it anymore. Like, what's the point of trying to predict what the future multiple is going to be in 10 years? It's just stupid. It makes so much more sense to say, what am I getting up front in terms of my earnings yield, and what is it likely to grow at? Your long-term return, provided that the company's earning at or above its cost of capital, or delivering returns at or above its cost of capital, is likely going to intersect with what those two numbers combine to be. If you have a company that is yielding you 12%, like upfront return, in terms of its earnings on what you're buying it for, and is likely to grow, like let's say it's yielding 12% and it's likely to grow at 10% per year, guess what? Your rate of return is likely going to be around 22%. As long as it's not, has a horrible return on capital, I think that is pretty close to what you're going to get, unless things change. Same thing, if you have a company that's yielding you 4% and is only going to grow at 2% per year, well, guess what? Your long-term return is probably going to be close to 6%. I think just keep it simple. But the most important thing is that you have some level of deep understanding of those individual numbers, and that they're just not things that you pulled quickly off the internet, like that you actually have an understanding of the business, so you can predict with reasonable certainty what your average long-term yield is going to be in terms of earnings, as well as what that growth rate approximately is going to be based off of things like market penetration and like how good the management is, and the runway, and all those things. So that's just my take. I hope you found it informative. Please remember to like and subscribe.